a very important concept in recording financial information is accounting equation. Yes, this is our current topic. So, accounting equation is basically resources are equal to the sources or the claims. When we say resources, we know very well it is asset. And when we say sources, these are the sources of finance which are owner's equity and liability. In fact, these owner's equity and liability are claim of the owner on the entity and of lenders on the entity. So, resources are equal to claim or resources are equal to the sources is the same thing. Initially, this equation is 0 equal to 0. Means in the entity, we are not having resources and there is no source of financing those resources. But subsequently, what happens that because of certain transactions, events and conditions, for example, the very first transaction that will happen, that is resources introduced by owner into the business. So, it will create increase in the left hand side and also increase in the right hand side. And then certain transactions will cause change, and that change could be a decrease in one side and decrease another side, or increase in one side and increase another side. But one thing also happens that if there is an increase or decrease happening on the same side, means at the asset side, in a way we are generating resources through another resource, so it will cause an increase in the resource side and at the same time decrease in the resource side. Or there will be increase or decrease in the source or claim side. We do remember that there are 5 main heads of accounts: assets, liabilities, owner's equity, incomes and expenses. So 3 have been covered in the basic accounting equation, 2 are left, and those 2 are incomes and expenses. So these incomes and expenses generate profit or loss. So what do we do in this equation? Income minus expense gives us profit or loss. So this profit or loss is in fact an item of owner's equity. What is owner's equity? In fact, owner, they introduce resource as finance to the entity. These are external source of financing. So this external source of financing is either from the owner side or from the lender side. But we are focusing on owner's equity. So we will say that owner's equity is introduced by owners by bringing their resources from their personal side into the entity, and internal sources or internally generated sources are the profits. So owner's equity is in fact the capital introduced by the owner or coming from external sources into the entity, and the profit. And profit is generated through this equation, which is incomes minus expenses. So profit or loss are an item of owner's equity. So the equation would be owner's equity is equal to the capital introduced by the owner plus the profit generated by the entity, or if there is a loss, we have to subtract that loss from this equation, and minus drawings. Drawings are in fact the resources taken away by the owner from the entity. So important tips to remember the ITTRs of this module are that resources are equal to the sources or the claims. And initially the equation is 0 equal to 0 initially, at the start, at the beginning of the entity. And owners bring personal resources in the business as source of finance. And sources are invested by external investors as well as generated through internal profits. Thank you.